All right, Santa Claus rode into the Brookings Institute today, and the market cheered that rally. So we had one of the bigger rallies of the year, not the biggest rally of the year, but one of the bigger rallies of the year today. Kind of mimicking what we saw from the last inflation report, the kind of move we saw from the last inflation report. I think the market heard the same things today as to what they felt would be said following that inflation report. Even though the FOMC odds in terms of like rate hikes are still the same. They're still the same going forward. But that didn't stop the market, and hence why we have an even bigger inversion now of the, in fact, we even have a pretty deep inversion of the 10-year and the overnight rate as we head towards, we're at 30 basis points now, and we head towards potentially 80 basis points at the next meeting. So interesting market response. We'll take a look at the technical breakouts that occurred and what the technical signals produced on today's move, how the move compares from one index to the next, where we line up and how bullish some are and some aren't. And we'll take a look at the sector moves and the different asset classes. It was a really fascinating move among the asset classes. Some moves you expected, some moves we didn't. So I'll break that down. And then our trade idea of the day is a stock that took advantage of the rally to start filling in some of its gaps. So we'll talk about how to trade that, given that it doesn't have as much upside before it hits some significant resistance. So what kind of trade can we do? We'll look at that. So let's go ahead and get started. Today is Wednesday, November the 30th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here in the right corner, or the red subscribe button down there. Hit the thumbs up icon to like our video today. Comment on anything that stood out to you. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things over here on the right-hand side. You can also come down here, click on that heart. It opens up this tab. Hit that like button. Same thing with this thumbs up icon. Click that thumbs up. Again, that likes our content here. It helps us get our content out to more of our followers on those platforms. The more likes and shares and retweets and comments that they all have. So we really appreciate those that do that day in and day out. You can do that right now while you're watching. Just scroll down to the bottom of the video there and click on it while you're watching. All right, let's start off taking a look at the S&P 500 with the market forecast indicator, and big time move and coming off of Powell's comments, which really haven't been much different, but as I said before, but still the market really liked it, and it busted through 4,000 in a big way. We ended up finishing at 40.80. That's the highest close we've had this entire rally. Big time push to the upside. The range was more than double the average. Remember, the average has really come down quite a bit. The range is more than that, so very extreme on the range. So big move, getting above this 62% and this 38% of this is the 38% of the long-term level, 62% of this intermediate run that we're on. The momentum line did spike this time up to upper reversal. So again, the near-term line should follow suit. Very similar to what we saw right here, right? The momentum line spikes. The near-term line follows suit. In this case, the near-term line's got a little bit further to run, but it should also get up here into the upper, unless, again, we have a significantly down day tomorrow that reverses what we have, which is unlikely, right? We'll probably end up with something at least like this, pushing up towards really not, this 4150, which is the 78%. Remember, when you have retracements, the retracements start when you get above, in this case, retracement to the upside. When you have a retracement to the upside, it starts when you get above the 23% retracement. It ends when either you get back below it or you get above the 78%. Because when you get above the 78%, now all the impulse moves are to the upside, right? And all the retracements are to the downside. So right now, that's been the opposite. We've been going to lower highs and lower lows. But once you get above 78%, now you expect a retracement to the downside. Like, you don't expect that we would go down to even to lower lows, much less even equal lows. So that's an important level, as well as that all important 50% level, right, of this entire decline that we learned back in August, that if we get above it, we never go back down to new lows. Now, that wasn't the case in August. So I guess this was the one time ever that has happened that we actually did get to lower lows, slightly lower lows, because we were just a little bit above the 50% line there. But so that's at 41.52. So getting above those two lines, now we have an impulse move to the upside. We have, the famous 50% level, and you also have this 23% line around 4,200, which is, again, the retracement starts. This is the retracement of the COVID rally off the COVID low. So we started the retracement, you got below 23%, you can get a little bit above it, and then now you get back above it again, and now again the retracement's over. So this would be the beginning of the retracement, this would be the end of the retracement. The retracement would be over at that point. It was almost over there in August. Got up to that 62% retracement and stopped. It wasn't the 62% at the time. It got above the 50%. You can see at the time, if I were to move this, let me activate this and move it over here. So at the time, you can see we were below the 62, but see how we were above the 50 pretty easy there. So now, if I were to activate this and move it back to where we are here, now we are still not above the 50, but that 62 is right there. And so you can kind of see what we've got here. Like, we can really get going to the upside now if this, if we continue to follow through on this, extreme rally. Like I said, more than 2 times. We haven't had that big of a move again since back over here, 11/10, and that was the CPI day, right? That was the day that we had the really dovish CPI report. The Fed is going to slow down their rate hikes. And the market rallied significantly. That was a huge. That day itself was a 98-day range, but you have to add on the gap to go with it. This was actually even more significant because we didn't have all the gain was during the day today. About whatever time it was, 1:30 Eastern time, that his speech there at the Brookings Institute came out. We're 5% above the 30-day moving average, so looking really good there from that perspective. Let's look at the Dow. Remember, the Dow Jones has actually been pretty bullish. So it's been up here. There, now I have all the equivalent lines here drawn, again, including the black and red lines that go back to the post-COVID rally as well as the post-2009 low point rally. So you can see we did get above the 50% and now the 62% retracement. We got above that actually last week, and we're holding it after a little bit of a pullback. And now we are easily above the 100% line. So this little rally we had coming off of this level, the current intermediate run, obviously we got above the 78% line, and we're above the 100%. And we're really pushing. We're above. I mean, again, if this were the S&P 500, we would be feeling really good about life. So again, we are right here. If this were the S&P 500, this is where we'd be at. And if we were at 4,400 or higher, again, that's what Tom Lee's been calling for, right? 4,400 to 4,500 by the end of the year, or 4,800 earlier. But that's what he's been calling for. We would be there if this were the Dow, because that's the equivalent levels that the Dow has already eclipsed. Remember, we are above the 38 and the 62. When you look at the NASDAQ, again, when you look at those equivalent levels, the 100% is right there. And let me edit this really quick. Oops, excuse me. I'll activate it. Might be the best thing to do. Activate that and move it right to that. Activate it, move it here to that high point. Again, the 100% line, the 62% retracement's way up here. So the NASDAQ would actually be up above 14,400. If we were above the same equivalent levels as well as that 23% retracement line. This is, and again, we're down here. So that's how much the NASDAQ has been lagging behind. It actually has not eclipsed the high point, right, of a few weeks ago. Though it is a really strong move. And again, getting above the 38% line clearly and getting above the 23% line. See, we're just barely getting above the 23% line of this year-to-date decline that we've been on. Remember, the Dow is above the 62% retracement. The S&P is above the 50%, right? Or at least close to it. It's above the 38%, and it's getting closer to the 50. The NASDAQ is barely getting above the 23. And you can see how also when you look at the NASDAQ, there's that black and red line, the 38 and the 23 of those long-term moves. We're still easily below that for the NASDAQ, as well as the Russell 2000. When you look at the Russell 2000 here, here's the Russell 2000 again at the 62% retracement, again not above these highs, unlike the Dow and the Nasdaq. And then there's the 23% line. There's the 100% line over here. I don't know why this keeps doing this. Move it over to the actual high point there. There's the 100% retracement line. There's the 50%. The 62 is actually way up here. So the Russell would be at least up into this area around 2100. And again, we're way down here at 1886. So you can kind of get the idea that just how much the Dow has been outperforming and then everything else. I mean, we're still, there's still some pretty significant resistance here for the Russell, even if everything else has been kind of breaking through pretty easily. Their own resistance levels. And the good rally here too has actually produced a higher close and a close back above for the second time. Actually the third time if you include March, because we did get back above it over there too. But this would be the third time this year we have closed above the 40-week moving average. And then we will next week, again barring a significant collapse by the end of the week. Again, we're trading at 40.80, so that's right up into this area. So that's how big the candle is going to be next week already. So things are looking pretty decent for a good break above that level too, above the 40-week moving average, again for the first time, and potentially even getting the PPO. The PPO is as high now as it was then too. So we have a really, really good opportunity to finally kind of turn this ship around and actually get it going positive. When you look at the 3 green arrow chart here, you can see that we're back to 3 green arrows across the board, except for the Dow Jones and the Russell. Those are the two that don't have it quite yet, but at least on the S&P and the Qs, you are back to 3 green arrows. When you look at the volume, remember the range was more than twice. The volume was extreme. This is the biggest amount of volume we've had. Let's see, we were at 140. Let's see here. This would be 147, 250, and today we're at 144, and this one over here was at 153. So, you could say it's the third biggest day of volume that we've seen for a while. These 3 days, bigger than everything else. You have to go back to over here. And these are all kind of declined. That was a big decline. That was a big decline. This was an engulfing pattern at the end, at the bottom. So this is one of our biggest moves on an up day, where we are actually moving to the upside. See, we didn't get any of these kind of volume days over here. We didn't get any of these kind of volume days over here during that rally. But we did here, 144.5 million shares trading hands. Like I said, 14 points. When you put those numbers in average, 14 points is way off the chart. 144 million is also off the chart in terms of the 52-week ranges for these indicators. So well above the average. Remember, this won't last, right? Because if these go up, usually that means the market's falling. So you get a good thrust like this. Hopefully, like I said before, ideally you want that big thrust to actually produce a level above 100. Since we were below 100, you want it to be above 100. We still haven't gotten a move above 100. In fact, today's move got us to 50. And then when you look at the on-balance volume, we're still not very, we are relatively bullish, we're still kind of flat, but you have to go back to this. The money flow index is about the same levels it was back on October 25th. It's just actually a smidgen below it still, but the price was over here at 385, and now we're at 407. So we've really rallied again without the volume. And if you go all the way back to last time we got to 407, so over here we got to 410, 411. But on this day, on 9/9, right here, and 9/9, we were at the same level, pretty much the same level, and you can see over to the right of my cursor just where the volume is associated with that. We're just nowhere near those levels. And again, once you get to the 50%, every other time we've had a correction low point, so a move off of a correction low and then a move up to new highs. By the time we reach the 50% retracement level, which would be right here where my cursor is, by the time we reached it, we matched the volume of what we saw when we hit it the first time. So when we were kind of in this area right here, if you follow my cursor all the way to the right, that's about where, it's actually about right into this area. That's about where we should be there. Right now, we should be there as we approach that 50% retracement level and get above it. See, that was not the case over here, and that's why we were one of the reasons why we weren't that bullish there. And so far, it's not even close to being the case. It's even worse right now because we're actually lower now than we were there in August. See, we're getting up to these August levels. Last time we got up to this level during the August run, again, this is where the volume was, and we're nowhere near that. So it's like, dang, we're really not getting the kind of the breadth that we need here from the McClellan oscillator or the on-balance volume, the money flow. We are getting a really significant move to the upside in the DMI. The negative indicator dropped back down below 20 barely. Dropped back down below 20 there. When you look at the RSI and the CCI, so kind of bullish, not the most, but kind of bullish there. We are back above 60. In fact, this is the highest level so far we've seen. Remember, we got above 70 there, and that was the last hurrah. And we are up to 150 on the CCI, so avoided getting into the lower half of the chart on both of these and stayed in bullish territory. We are still in a bullish trend, well above the cloud. And, again, staying above the cloud by the time we turn green is imperative. We don't have a mature trend going yet, but at least we maintain a bearish, an intermediate trend strength. So that's looking pretty positive. And then when you look at the Bollinger Bands here for the S&P, you can see we are in the upper quartile of the bandwidth that's rising. And when you look at it with the Keltner channels, we are above the Keltner. We went from being pretty much in the middle of the channel to being outside the upper channel with some positive momentum still. This is a pretty decently long. You can see how the momentum kind of goes during these other bullish runs. This has probably been at least matching the length of this one from a momentum standpoint, and obviously a lot longer than the one that we saw at the end of March. So good, at least a good sign there to get up above. The volatility index dropped like a rock, down 5% right after that speech, down to 20. Again, not getting below 20 yet, but we are easily below 90%. You can see that here. Let me pull up this chart. You can see that here on the daily chart, just how bearish that is. The volatility of the VVIX. I will pull up the VVIX here. Again, getting back down towards 80. So again, these are in the 80s and the low 80s are really low levels for the volatility of the index. And you can see the correlation of the VIX with the volatility of the VIX is back below zero. Again, it's very rare when that happens, and in the past has led to bullish runs in both the VIX and the VVIX. So kind of keep that in mind with how the volatility is behaving right now. It's pretty low, and its downside is limited considering just how bearish we've already been in volatility, and we still haven't, as bearish as we've been, we still haven't gotten below 20, and with the VVIX already extremely low. And the VIX the VIX relative to the VIX 3M is so low, it's going to be hard to really put more downward pressure on it, considering that we're already so low there. All right, let's take a look at what's driving the price action. You can see the outsized move we had in equities here on the 3-month chart. Let's zoom in on how things performed here today. So we'll go to the 30th, and then we'll come back to just a smaller time frame. I mean, look at the Qs. They killed it today, up 4.5%. A tremendous, as big as the S&P was, and how extreme that was, a 3% rally. Again, I mean, if I were to look at the daily bars here on SPY, 3% move. It's not the first 3% move we've had this year. It's actually the 1, 2, 3, 4, fourth. There's fifth. Excuse me. It's the fifth 3% move. And if you look at the Qs, this is not the first time it's been up. In this case, 4.5% looks like. It was actually up 7% over here, and you can see the declines we had after that. It was up 4.25%. So this is the second biggest move for the Qs all year long. So needless to say, I mean, it's a pretty decent move, relatively speaking, for most of this year. And again, probably if you were to talk to people, they would say, looking for a narrative that drives this action, you would say a lot of it had to do with bonds. And bonds did rally. You can see they rallied. They kind of came off, and they were up 0.75%. Yields came down. The dollar dropped like a rock after that speech, and you can see that helped push gold up. The problem is going into it, commodities and emerging markets, because of China, were doing really, really well. Commodities stayed higher, and that's not necessarily too big of an issue, other than again, if it really takes off, for this would be like the third time that it gets back above the 23% and above the 200-day moving average. But if it takes off above this point of control, above this big volume though, that keeps just getting bigger and bigger, then we start to get inflationary pressures. And again, we've seen this story play out before. The Fed raises rates because of high inflation. The Fed stops raising rates because they get pressured by people, because they honestly kept it too low for too long, and now they're trying. They moved it up so far so fast because they were so far behind the curve, and they're getting a lot of pressure to slow it down. And what happens? The dollar drops, and inflation goes up, or commodity prices go up again, and drives inflation levels back up again. You can see the dollar breaking down here below that 38% retracement level. There's still a pretty decent sized volume node here that you have to break below, and then you look at long-term bonds, and they're up there, but you can see like the MACD histogram has already peaked. So now we look for the MACD to peak, and at best you look for a convergence scenario where the MACD gets below its moving average, but we stay above the 17. But that typically ends the bullish move when you get a convergence scenario. Just protracts the ending further. So you wouldn't expect there to be a lot more to go to the upside for bonds, or much to room to the downside, when again, like we've talked about before, when you look at the odds for rate hikes going into the end of the year, you can see the odds are still 100% that you're going to get a 50 basis point hike. Remember, the 10-year note's at 370, slightly below. There's still actually a 20% chance that we're going to have a 75 basis point. I mean, that's low probability, but it's still a probability. And then again, we have a 100% chance of getting the 475 by the February meeting, and I believe it's the May meeting. Maybe it was June. The June meeting, we have an 87% chance, and I believe the May meeting as well, we have an 87% chance we'll be at 5%. So we have a relatively high probability we're still going to get the 5%, and the 10 years at 3.7. Like the Fed doesn't generally have such a big inversion, even between the 3 and the 10 year, but much less between, which is at 76 basis points. I mean, that spread dropped 10 basis points today. The spread between the 10 year and the 3 month dropped 10 basis points down to 0.76. The 2 year, the 10 year dropped. There's a bigger spread right now between the 10 year and the 3 month than there is between the 10 year and the 2 year. It's the first time all year that's been the case. And then of course, again, if the Fed raises rates to 4.5% at the next meeting here in December, which is only 2 weeks away, which they're widely expected to, if the 10-year note doesn't rise, you're about to get an 80 basis point gap between the 10-year note and the Fed funds rate, the overnight rate, which is an insanely large inversion between the overnight rate and this longer term or intermediate term yield spread. So, I mean, there's not a lot of downside here to yields, and especially there's not a lot of downside, considering that the yield spreads are so low. Again, there are two ways that this can get back to zero or higher. Two ways it can get back to zero or higher. And remember, every time the yield spread rallies, these are all bear markets, right? These are all bearish times in the market, bearish time in the market, bearish time in the market. So when we come from below zero up, it tends to coincide with a bearish time in the market, because in this particular case, it will go up for one of two reasons. The Fed is cutting rates, which they won't do unless we are in dire scenario, because that's the last thing they want to do right now is cut rates. So that's number one. Or number two, long-term rates start to really rise again. So what's the one thing that would make the long-term rates really rise again? And that is the inflation levels starting to rise, right? The inflation levels maintaining, they've been pulling back here, but stopping their pullback and then turning higher. And what would make it turn higher? Again, like we talked about, it would be a continuation of bullishness in the commodities space. In this case, the crude oil getting above the 8-day moving average, but you can see the commodity space here. I mean, this has been a pretty good week. One of the better weeks that we've seen here for, like we did a few weeks ago, we had a pretty decent run getting above the 17 and the 30-day barely on the same week. Well, right now we're engulfing this pattern and almost getting back above the 17-day with the MACD still above its moving average. So again, I mean, we're still pretty high. Like March of last year is when inflation levels really took off. The growth rate for inflation levels really took off. This is how much higher we still are in commodity prices compared to them. So if we start to ramp back up again, you'll start to see inflation levels ramp back up again too. And again, that's what would make long-term yields go up. That's what would make the yield spread go up. And right now, that would be a bearish scenario for the broader markets if that were to play out that way. Looking at the sector moves, let's see here, the sector right here and how they performed today. So let's just go look at today, November the 30th. Here we go. You can see XOK, XLY, XOC, right? That's those are the three you want to lead. They were the ones that did lead. So this was a full-on risk appetite day, and your biggest underperformers, because they weren't losers, but your biggest underperformers were energy, which has been a year-to-date winner, and has really diverged from what crude oil prices are doing. And then you also have industrials and financials, which have been, doing pretty well for most of this current cycle to the upside, along with materials and energy, of course. Materials kind of matching some of these other safe haven areas that also did. I mean, safe haven 2% to 2.5% for the safe haven areas. That's pretty good, right? That's a pretty good bullish move for those major sectors. And of course, like I said, across the world, you're seeing some pretty decent strength here. If I look at the 12 grid for the 12 biggest economies, and the countries with the 12 biggest economies, and then their ETFs or corresponding ETFs, that's a lot of dark green shading and green line all across the board there. And China had the biggest move, really busting out to the upside. I mean, you're getting a good move in emerging markets. Remember, they have the better margin of safety. So they have a good opportunity to make up some ground and get some PE expansion on a long-term basis to catch up, to either catch up to where the U.S. is or for the U.S. to catch down to where it is, depending upon what kind of market we end up in for the good chunk of 2023. But that's a lot of bullishness. Even Brazil is finally not pink anymore and is back above its moving average, barely. And giving an opportunity for some bullishness here. Not necessarily getting up. I mean, I think India and China are your two biggest movers that are above the highs that we saw from a week or so ago, a couple weeks ago. Not everything is necessarily so strongly above those previous highs. All right, so for our trade idea of the day, I wanted to take a look at Take Two. You can see the nice breakout Take Two's had filling into a gap that had post-earnings. Has really recovered off of that earnings really, really well. Momentum line's gotten up, just like the market, into high levels multiple times. You would expect the near term will follow suit. The longer it stays up here, the intermediate line will follow suit with the blue line, and we'll work our way up to the upside. So, and it's above the market sentiment. Still in bearish territory. We're still 3% below. So we haven't crossed above the moving average yet. So we're not the most bullish here quite yet, but things are definitely improving. For the company, it's been so bearish, right? You can see here on the weekly chart that we got after getting multiple bearish candles, big bearish candles, we finally got a little bit of a reversal candle, kind of like what we saw over here. Not a green arrow yet, but at least it's bullish, and the PPO appears to be rounding out from relatively low levels. When you look at the 3 green arrow chart for the stock, You can see that we rallied up above the 8 and the 17-day moving averages here today. Still below the value area, but that's a pretty good bullish move considering that the MACD was already positive for quite a while in this convergence mode, and the stochastics is already easily in the bullish territory. So it's, we've been on the verge of it turning bullish, and today it appears to be, that verge has played out to where we're now not nearly as bearish anymore and starting to get somewhat better patterns. You can see we're back above. We're not below 25 yet on the bearish indicator, the negative indicator on the DMI, but we are above 20 now on the positive. So we are getting some signs of improvement there. The RSI and the CCI you can see as well, getting back up into the upper half of the chart already on the CCI, getting nearly to above 150 or 200. And at least, probably by tomorrow, you'll be above 50 on the RSI into the upper half of that chart. Looking at the, it was the Bollinger Bands. Looking at the Bollinger Bands and the Keltner channels here for take two, you can see the breakout into the upper half of the chart now after being in the lower half for so long with that earnings announcement, right? We're getting back into the upper half with that bandwidth coming in. You can see the bands are actually, even as much as they've come in, the bands are actually still outside the Keltner channels, as crazy as that seems. If I were to zoom in here, you can see it a little bit better. There you can see how much that's come in, and then if I look at the, let me try to zoom in here and see if that one is a little easier to see. Yeah, this one's a little easier to see too. So it's still below the value area, still down in relatively bearish territory. But you can see here it's probably better just to, we got to keep that. I would like to keep the volume profile there. But you can see how, we're in the bottom of the value, working our way up to a volume node here that's right around 125. I think that's where you got the potential, because remember, that's where these longer term moving averages are as well. And we'll see if we can't, while the bands are still outside the Keltner channels, get just as volatile move to the upside as you had here to the downside. So it's not the most bullish pattern, but it's bullish enough that I think we can do a bull put spread on it. So I sold the mid-third, was actually at the time of our Market Outlook Live video that I did for our subscribers before the market closed. We sold the 100 and was around the 35 delta, bought the 95, so this is what it looks like on the Analyze tab. Get rid of that here. Full position size, getting a 30% return on risk. You need at least $1.16 on a $5 Y to get a 30% return on risk. We're getting $1.25. So it meets that criteria, and you can see that break even here is actually down below. So we'd have to get back below this little breakout. See how we broke above last week's high? We're breaking into, which actually was the high point from a few weeks ago as well, and into continuing to fill in this gap and well above the value area the last 4 weeks, really moving your way to the, at least with potential, moving your way to the upside here, and a big chunk of volume to go with it. If you look at the volume here for take two, we didn't look at this chart. Big, like not quite 3 green arrows, but more than 1.5 times the average volume. So a nice, good day. So I think not bullish enough that I like buy a call option or like a long call vertical, but bullish enough that I can do a bull put spread with a relatively high probability and be able to get a decent return going into now a January expiration. So one of our first January directional trades that we've made here. Earlier this week we made some more in our class, in our directional option strategies class. I think this is our first one for our market outlook category that we've made. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Apply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Like us on Twitter and Facebook as well. Join our website, marketscholars.com, for free. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.